the smartest institutions on Wall Street have collectively decided that prediction markets are the future of information aggregation. Intercontinental Exchange, the parent company of the New York Stock Exchange, has committed roughly $2 billion to Polymarket. Kalshi has rocketed from a $2 billion valuation to $22 billion in less than 12 months, and Bernstein is now projecting $1 trillion in annual volume by 2030. But this entire structure rests on a regulatory foundation so fragile that one person at one federal agency could begin dismantling it tomorrow morning. And most users with money on these platforms have absolutely no idea they are making that kind of bet. My name is DC, and you're watching The Coin Bureau. Now, to fully comprehend just how exposed this industry has become, we have to begin with the sheer scale of what has been constructed in approximately 18 months. In early 2024, Polymarket had roughly 4,000 monthly active users and was widely regarded as a niche curiosity for crypto natives who wanted to wager on election outcomes outside the United States legal parameter. By April 2026, that same platform processes more than 700,000 monthly active users, recorded over 45 million web visits in a single month, and is operating at an annualized volume run rate exceeding $100 billion. And if you think that's intense, Kalshi's trajectory is even more extreme. Weekly notional volume has scaled from roughly $100 million 1 year ago to more than $3.5 billion in the week of the 2026 Masters Tournament alone. Meanwhile, monthly active users have climbed from 600,000 in January 2025 to 5.1 million today. And fee revenue surged 994% year over year, taking the company from approximately 24 million in 2024 to roughly 263 million in the following year, with an annualized run rate now sitting between $1 and $1.5 billion. Of course, those numbers have attracted the attention of some big names. Fox Corporation signed a sponsored data deal with Kalshi in March. CNN has integrated Kalshi probability tickers into broadcast output. The Wall Street Journal has partnered with Polymarket on data distribution, and Google Finance now embeds live odds from both platforms directly into financial searches. The NBA is in active negotiations with both venues. Polymarket secured an exclusive arrangement with Major League Baseball, and Donald Trump Jr. now sits as a paid strategic advisor to Kalshi while simultaneously holding an advisory board position at Polymarket through an 8-figure investment via 1789 Capital. This is the part that crypto native press loves to celebrate, and what it deliberately glosses over is the structural vulnerability that scales in lockstep with the boom itself. The bigger these platforms become, the more they have to lose if the regulatory wind reverses, and the more institutional capital is sitting in vehicles whose continued existence depends entirely on conditions outside their control. You see, the entire legal foundation for this category rests on a single statutory interpretation. Event contracts, the binary options that pay out based on political, sports, or geopolitical outcomes, are classified as swaps under the Commodity Exchange Act, and that classification grants the Commodity Futures Trading Commission, or the CFTC, exclusive federal jurisdiction over any registered designated contract market. Under this theory, state gambling regulators are constitutionally preempted, meaning their statutes simply do not apply to a federally registered exchange. That interpretation is not settled law. It's a district court ruling from September 2024 in Kalshi X versus the CFTC, which the Trump-era commission voluntarily declined to appeal in May 2025. And the 3-0 vote to drop the appeal cemented that ruling as the legal bedrock the entire industry now stands on. 2 of the last 3 administrations would have rejected that interpretation outright, and the commissioner composition that protects it today is extraordinarily thin. Now, before we talk about the part that almost nobody outside of regulatory law is talking about, if you want to keep up with what's going on in crypto and beyond in real time, then you need the Coin Bureau Telegram channel. This is where we post regular updates with all the info you need to stay on top of the markets. You can sign up using the link in the description or simply scan the QR code you're seeing right now. Lovely. Right back to the matter at hand. So, the CFTC normally operates with 5 commissioners with no more than 3 from any single party. But as of April 2026, Chairman Michael Selig is the only sitting commissioner at the entire agency. Every protective action that has shielded prediction markets in the last 6 months, including the February 2026 withdrawal of the proposed ban on event contracts, the March advance notice of proposed rulemaking, and the offensive litigation against state regulators in Arizona, Connecticut, and Illinois, has been executed by one person acting alone. Former Commissioner Kristin Johnson has publicly called this single commissioner structure a disservice to regulation, and the agency lacks the resources to oversee a category that grew from approximately 5 event contract listings per year between 2006 and 2020 to roughly 1,600 listings in 2025 alone. The CLIC CFTC has chosen to use what little capacity it has to defend the industry from state encroachment rather than to regulate it. And state encroachment is mounting on every single front. In April, the Ohio Casino Control Commission issued a $5 million fine against Kalshi for operating an unlicensed sportsbook in defiance of a cease and desist order. And federal judge Sarah Morrison ruled in March that Kalshi's products amounted to gambling under Ohio law. Arizona Attorney General Chris Mays filed 20 criminal misdemeanor counts against the company, only blocked from a prosecution by a federal temporary restraining order that the CFTC itself obtained. Nevada and Massachusetts both secured injunctions. Maryland's federal court denied Kalshi's request for one, and Montana, Washington, Connecticut, and Illinois are all in active litigation, meaning the company is now defending itself across roughly 13 to 15 states simultaneously. The Third Circuit handed Kalshi a major appellate victory in April, ruling 2-1 that sports event contracts on a CFTC-regulated exchange are swaps, and that federal law preempts state gaming regulations. But Judge Jane Richard Roth's dissent is the part to take seriously. She wrote that Kalshi's offerings are virtually indistinguishable from DraftKings and FanDuel, that the financial swap classification is a legal fiction used specifically to circumvent state consumer protections, and that dissent is the legal theory a future democratic CFTC would adopt and a future Supreme Court might validate. Senators Curtis and Schiff introduced the Prediction Markets Are Gambling Act in March, a bipartisan attempt to amend the Commodity Exchange Act and explicitly classify these contracts as gambling. While Senator Jeff Merkley and Representative Jamie Raskin introduced the more aggressive Stop Corrupt Bats Act, with Warren Blumenthal, Van Hollen, and Whitehouse all signed on as co-sponsors. So the legislative playbook for dismantling this industry is already drafted, already in committee, and waiting for the political conditions that allow it to advance. And here's where the story gets genuinely interesting, because the two dominant platforms have placed almost diametrically opposite bets on which version of the future arrives. Kalshi went the institutional, fully CFTC-regulated route from inception, operating as a registered designated contract market with an affiliated clearing organization, and its strategy treats federal registration as a preemptive shield against any state-level enforcement. Susquehanna provides institutional market making, Sequoia and Paradigm sit on the cap table, and the company spent roughly $615,000 on federal lobbying last year alone. Now, Polymarket took the opposite path. The platform was crypto-native from day one, USDC denominated, settling on the Polygon blockchain, originally operating offshore through a Panama entity precisely because that structure allowed it to bypass United States jurisdiction. The original Blockratise entity settled with the CFTC for $1.4 million in 2022. The FBI raided CEO Shane Copland's Manhattan apartment in November 2024 in the dying days of the Biden administration, and then both the DOJ and CFTC formally closed those investigations in early 2025 under the new administration. Polymarket promptly acquired QCEX for $112 million to gain its own CFTC-licensed exchange and clearinghouse, returning to the United States market under an amended order of designation issued by the very same single commissioner agency we just discussed. However, the reality is that under a hostile administration, both bets could fail at the same time. Kalshi's compliance becomes irrelevant if a future CFTC simply revises what compliance means and starts denying renewals on public interest grounds, while Polymarket's decentralization becomes irrelevant, if Circle is pressured to blacklist stablecoin flows to its smart contracts, if on-ramps are blocked at the payment processor level, or if the amended order of designation that allowed its US return is reviewed and revoked by a successor commission. The institutional shield and the crypto-native shield protect against entirely different threats, and neither one is calibrated against a coordinated administrative reversal. But wait, there's more. You see, the entities that decide what actually happened, the people who resolve a contested market, hold enormous economic power. And the settlement transparency of this entire category is the unspoken weak point that nobody in the industry wants to address publicly. Polymarket's international markets resolve through UMA protocol, an optimistic oracle where token holders vote on contested outcomes. In December 2024, a $16 million Polymarket contract on whether the Trump administration would declassify UFO files resolved yes, despite no documents ever being publicly released. And the platform later acknowledged the oracle had reached an incorrect outcome, with critics describing the resolution as a governance attack by UMA token holders who held positions on the very outcome they were voting to validate. Kalshi, meanwhile, has its own resolution problem. A $47 million Super Bowl halftime market in 2025 generated furious user complaints over the specific data source used for settlement, and the platform refunded all losses on a disputed Iran Supreme Leader contract, setting an ad hoc precedent that creates exactly the wrong incentive structure for handling future disputes. The most striking example, however, arrived this year. The Federal Reserve Chair nomination market generated more than $800 million in combined volume across both platforms. And Polymarket settled based on the White House submission, while Kalshi maintained its market would not resolve until the nomination was formally received by the Senate and verified by the Library of Congress. Two CFTC-adjacent venues, both using official sources, interpreted the resolution criteria differently with hundreds of millions of dollars at stake. Now extrapolate that disagreement to a contested election or a significant geopolitical event, which leads directly into the structural conflict that the SEC would never tolerate in equity markets, but which the current CFTC has elected to ignore entirely. Kevin Warsh, nominated by President Trump as Federal Reserve Chair, disclosed a direct financial stake in Polymarket through an LLC structure that conceals the exact value, even as Polymarket itself hosted a market betting on his own nomination. That single contract reached $432 million in volume. The combined Fed share markets across both platforms cleared the figure mentioned earlier, and Senator Elizabeth Warren has called for delaying his confirmation hearing specifically over the entanglement. And the Trump family's exposure compounds that problem dramatically. Donald Trump Jr. holds paid advisory roles at both Kalshi and Polymarket, while his father's administration directly oversees the regulatory framework governing both companies. Trump Media is even launching its own competing platform called Truth Predict in partnership with Crypto.com, and reports indicate that CFTC's enforcement actions against Kalshi were dropped after Trump Jr. joined the company. But wait, there's even more, which brings us to the trades themselves. In April this year, in the hours before the president announced an Iran ceasefire on Truth Social, at least 50 newly created accounts placed substantial yes bets on this outcome. One trader turned roughly $13,000 into $467,000, and a separate cluster cleared more than $600,000 on the same announcement. A trader operating as Mega My Man netted over $500,000 betting against Iranian Supreme Leader Khamenei's survival shortly before his death was announced. And linked wallets cleared roughly $300,000 on specific last-minute Biden pardons. None of these traders has faced federal charges, and the legal definition of material non-public information in a prediction market context simply does not exist in any clear or enforceable form. Which brings us directly to the question that nobody on the platforms is asking out loud. What actually happens to this entire architecture if Democrats take the White House in 2028? Well, the Predict It precedent is the answer to the question of whether a hostile CFTC can dismantle a prediction market platform. Under former chair Rustin Banham, the agency revoked Predict its no-action letter in August 2022, ordered the platform to wind down, and was only forced to back off because a federal court ruled the action arbitrary and capricious under the Administrative Procedure Act, with Predicted eventually winning full designated contract market status in September of last year. You see, the lesson cuts both ways. A future democratic CFTC cannot simply withdraw a letter and expect the action to survive litigation, but formal notice and comment rulemaking under the public interest provisions of the Commodity Exchange Act is a much harder action to challenge. And that is exactly the path Banham was already walking when his term ended. The realistic scenarios stack on top of each other. Restrictive rulemaking arrives first, probably within 12 to 18 months of a new administration, reviving the abandoned amendment to Regulation 4011 that would prohibit political event contracts as contrary to the public interest. Jurisdictional handover follows almost immediately as the new CFTC simply stops defending state preemption, allowing California, Connecticut, New York, and Illinois to enforce existing gambling statutes against these platforms. Retroactive enforcement begins on day one with the well-documented Iran ceasefire trades, the Maduro trades, and the Khamenei trades, all providing immediate, specific evidence-rich targets, and in the most aggressive scenario, the Stop Corrupt Bets Act passes through a unified democratic Congress and codifies a statutory ban that no court can overturn. The reality for users is harder to dismiss than the platforms suggest. Funds in already settled contracts are essentially safe, but active positions in suddenly prohibited markets create resolution chaos, and Polymarket's offshore architecture provides only partial insulation for technically sophisticated users with self-custody wallets. The moment Circle faces regulatory pressure to blacklist stablecoin flows to specific smart contract addresses, the practical accessibility of the platform collapses for anyone using a centralized on-ramp. And Kalshi's roughly 90% spots concentration means that a CFTC declining to defend exchange preemption on spots contracts would erode the bulk of its revenue base in a single quarter. The $22 billion valuation, the $1 trillion projection, the 5 million monthly active users, all of it depends entirely on the assumption that the regulatory environment remains structurally friendly. And that assumption is not a fact, it's a wager. And the people making it largely don't even know that they are making it. So prediction markets might genuinely turn out to be the future of information aggregation. The underlying thesis is clear, the technology functions as advertised, and the forecasting accuracy is real, with Wolf Research documenting Polymarket bettors predicting earnings beats at roughly 90% accuracy against an 81% benchmark. But the current boom is not proof the category is durable. It is proof that one specific political configuration tolerates it, and tolerance is not the same as legal protection. Every user with money on Polymarket or Kalshi today is making an implicit bet, not just on event outcomes, but on a regulatory window staying open through at least one more presidential transition, and that window has a very specific expiration date currently penciled in for January 2029. So here's the binary question that this entire industry refuses to face directly. Will prediction markets survive the next administration intact, evolving into the $1 trillion information layer that Wall Street is now pricing in? Or is every dollar currently sitting on Kalshi and Polymarket an unhedged bet on a regulatory tolerance that is guaranteed to eventually expire? Let us know how you stand on this in the comments below. And if you want to understand exactly how Circle and Tether are being repositioned as the choke points of the entire crypto industry, then you should definitely check out our deep dive video right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing off.